James had been told his whole life that building credit was simple. Pay your bills on time, keep your balances low, be patient, wait years, let the history age naturally, and eventually, slowly, the score would climb into territory where the good rates lived. So he did exactly that. For 4 years, James paid every bill on time, without exception. He never missed a payment. He kept his one credit card balance under 30%. He did everything the advice columns and finance blogs told him to do. And after 4 years of perfect behavior, his credit score sat at 659. Not bad, but not good enough. When James went to apply for a mortgage on a modest home in his city, the loan officer laid out the numbers with the flat expression of someone who delivers this kind of news daily. At his score, the interest rate would be 7.1% on a 30-year loan. On the home James was looking at, that rate translated into nearly $200,000 more in lifetime interest compared to what someone with a score above 760 would pay for the exact same house. James asked the question that changed everything. He asked whether there was anything at all he could do about his score before locking in the rate. The loan officer told him politely that credit scores move slowly. A few months would not make a meaningful difference. Come back when you were ready, and they would process the application. James did not come back in a few months. He came back in 11 weeks. His score was 771. The loan officer looked at the number on the screen, then looked at James, then looked at the screen again. James had not won a lawsuit. He had not paid off a massive debt. He had not done anything that required money he did not have. He had simply discovered a set of mechanisms built directly into how credit scores are calculated. Mechanisms the industry understands perfectly, uses routinely, and has essentially no incentive to explain to the people paying the highest rates because of their ignorance of them. This video is about what James learned, and by the end of it, you will understand why the conventional credit advice, pay on time, keep balances low, be patient, leaves so much out. The advice is technically accurate. Payment history and utilization are genuinely the two largest components of a credit score. Paying on time matters enormously. Keeping balances low matters enormously. But the advice frames credit improvement as an exclusively time-dependent process, as though the only variable you can influence is your own behavior going forward, and the only thing to do is wait for that behavior to accumulate into a better score. That framing is where the incompleteness lives, and the incompleteness is not accidental. Every month a person spends in the fair or good credit range rather than the excellent range is a month they pay higher interest rates, qualify for worse loan terms, face higher insurance premiums in many states, and contribute more revenue to the financial institutions serving them. The system that profits from that situation has no structural incentive to shorten it. Understanding credit improvement as a mechanical system with knowable rules, rather than a mysterious, slow process requiring only patience, is the shift that changes everything. The score follows rules. The rules can be understood, and once understood, they can be optimized, far faster than anyone in the industry will typically tell you. The first mechanism, authorized user accounts. The centerpiece of what James discovered is something called the authorized user system, and understanding it requires first understanding how credit scores treat account history. Your credit score is calculated using several factors. Payment history, whether you pay on time, accounts for roughly 35% of the score. Credit utilization, how much of your available credit you are currently using, accounts for roughly 30%. The length of your credit history accounts for approximately 15%. This includes the age of your oldest account, the age of your newest account, and the average age of all accounts combined. Most people treat the length of credit history as entirely fixed. You opened your first card at 22, you are now 28, you have 6 years of history, and there's nothing to be done about it except wait. This assumption feels logical. It is also where the most powerful credit optimization opportunity sits. When you become an authorized user on another person's credit card account, that account's full history is imported onto your credit report. The account's age, its payment record, its credit limit, and its utilization ratio all appear on your profile, as if you had been associated with that account from its very beginning. You do not need to use the card, you do not need to have access to it. The addition is purely a reporting relationship, not a spending one. This is exactly what James did. His father had 2 credit cards, one opened 17 years ago, one opened 11 years ago. Both had spotless payment histories. Both carried balances under 5% of their limits. James's father added him as an authorized user on both accounts, a process that took about 8 minutes online and required no physical card to be issued. Within 2 billing cycles, those accounts appeared on James's credit report. His average account age, previously just over 3 years, jumped to nearly 11 years. His total available credit more than doubled. His credit file, which had looked thin and young, suddenly looked established and robust. Alongside some utilization adjustments we will cover in a moment, this was the primary driver of his 112-point score increase in 11 weeks. The authorized user system was originally designed to help spouses share credit histories in households where one partner managed all the finances. Over time, the mechanism has been recognized as extending to any willing account holder. It is not a loophole in the sense of exploiting a flaw. It is a designed feature of the system, one that the credit industry is perfectly aware of and has chosen not to close, and equally not to advertise. For the strategy to work effectively, the account being added to must meet specific criteria. The payment history needs to be clean. Any missed payments import alongside the positive history and can damage rather than help. The utilization on the account should be low, ideally under 10%. The account should be old, with older accounts providing more benefit. And it is essential to verify that the card issuer reports authorized users to all 3 major credit bureaus, because not all of them do. The major national issuers generally do. Smaller regional banks and credit unions vary. The second mechanism, utilization timing. The second thing James learned produced results faster than almost anything else available to someone trying to optimize their score quickly. It has nothing to do with paying off debt and everything to do with understanding when debt is measured. Credit utilization, the ratio of your current balances to your total available credit, is calculated based on the balance your card issuer reports to the credit bureaus. That reporting typically happens on your statement closing date, not your payment due date, not the date you actually pay, the closing date of your statement, which is often a week or more before your payment is actually due. This creates a situation that quietly penalizes millions of people who are behaving responsibly. James was paying his credit card in full every month, never carrying a balance, never paying interest. But he was charging roughly $2,000 per month on a card with a $3,000 limit. When his statement closed, a $2,000 balance was reported to the bureaus, representing 67% utilization on that card. His score was being penalized for 67% utilization, despite the fact that he paid every cent of it within days. The adjustment is simple once you understand the mechanics. Pay down your balance before your statement closing, rather than waiting for your due date. If James reduces his balance to under $100 before the statement closes, his reported utilization on that card drops below 4%. The impact on his score appears within a single billing cycle, within weeks, not months. Optimal utilization for credit scoring purposes sits between 1 and 3%, not 0, which can actually be slightly less beneficial than a tiny positive balance, and not the commonly cited 30% threshold, which is better described as a ceiling to stay under rather than a target to aim for. Getting every card to report under 5% utilization by managing payment timing is one of the fastest score improvements available to anyone at any income level with any starting score. The third mechanism, credit limit increases. Utilization is a ratio. Most people focus entirely on reducing the numerator, the balance. Very few people think strategically about increasing the denominator, the available credit limit, which achieves the same mathematical result. Many major credit card issuers allow customers to request credit limit increases with no hard inquiry on their credit report. This means requesting the increase does not temporarily lower your score the way applying for a new card would. American Express, in particular, is known for processing limit increase requests through a soft pull that leaves no mark on your credit report. James requested limit increases on both of his existing cards during his 11-week optimization period. Combined, his available credit increased by $8,000 with no new accounts opened and no hard inquiries recorded. That increase alone dropped his overall utilization ratio significantly, contributing to a meaningful score improvement before the authorized user accounts had even appeared on his report. The fourth mechanism James learned about is one that most consumers never encounter because it is not directly accessible to individuals, but knowing it exists fundamentally changes how you time your credit optimization efforts. Rapid rescoring is a process by which mortgage lenders can request that credit bureaus immediately update specific items on an applicant's report based on documentation provided. Rather than waiting for the next billing cycle to reflect a paid-down balance or a new authorized user account, a lender can submit proof of the change and have it reflected in the score within 72 hours. James's loan officer, who was considerably more helpful on his return visit than on his first, was able to use rapid rescoring to immediately reflect the last of James's utilization improvements that had not yet appeared on his report through the normal cycle. The process added another 14 points to his score in days rather than weeks, pushing him comfortably into the range that qualified him for the best available rate. Rapid rescoring is only accessible through a lender during an active mortgage or loan application. But understanding that it exists shapes the strategy. Rather than completing all credit optimization months before an application and hoping the improvements hold, you can time some optimizations to happen during the application process itself and have them reflected almost immediately. James's story ended well, but it required careful execution. The same strategies applied carelessly can produce disappointing results or even backfire. The most common mistake with the authorized user approach is being added to an account that appears strong on the surface but carries hidden problems. An account with even one missed payment in its history will import that negative mark alongside the positive age and payment history. An account with high utilization will damage your utilization ratio rather than improving it. Vetting the account thoroughly before being added, confirming clean payment history, low utilization, and the issuer's reporting practices is essential. The second common mistake is applying for new credit simultaneously with optimization efforts. Each application for a new credit account generates a hard inquiry that temporarily reduces a score by 5 to 10 points. Opening a new account also reduces average account age. People sometimes pursue a new card while simultaneously trying to age their credit history upward through authorized user accounts, two forces working in opposite directions. The third mistake is inconsistency in utilization timing. Paying before the statement closing date works reliably only when done consistently. A single month of high reported utilization can erase weeks of careful management. The fix is straightforward. Set a calendar reminder several days before each statement closes and make the payment then, rather than at the due date. The fourth mistake is pulling credit reports to check progress before sufficient time has passed. Changes take 1 to 2 full billing cycles to appear across all 3 bureaus. Checking too early, finding no change, and concluding the strategy failed leads people to abandon approaches that simply had not finished processing yet. The right combination of these strategies depends on where a credit score currently sits and why. For scores below 650, the authorized user approach typically offers the largest single improvement. Thin credit files, ones with few accounts and short histories, benefit most dramatically from imported age and history. Combining authorized user addition with utilization timing optimization and a limit increase request creates multiple simultaneous improvements that compound within a single billing cycle. For scores between 650 and 720, the optimization zone where many people plateau, the most impactful moves are often utilization timing and limit increases, since accounts in this range frequently have reasonable histories but reported utilization that is higher than optimal. Closing the gap between a 680 and a 750 score is often primarily a utilization management exercise. For scores above 720, the differences still matter, particularly for mortgage rates, where the gap between a 730 score and a 780 score can translate into tens of thousands of dollars in lifetime interest. Authorized user additions from accounts older than the current oldest account, combined with meticulous utilization management, can provide the final push into the highest rate brackets. Regardless of starting score, reviewing credit reports from all three major bureaus for errors is a step that runs parallel to every other strategy. A meaningful percentage of credit reports contain inaccuracies, and some of those inaccuracies are score-affecting. Disputing legitimate errors is a separate process from the optimization strategies described here, and both should happen together. When James walked out of the mortgage lender's office with a rate that will save him over $200,000 in lifetime interest, he said something worth sitting with. He said he was not angry about the years he spent not knowing this. He was thoughtful about it. Because the knowledge was always available. The rules of credit scoring are documented. The authorized user system is explicitly legal and officially recognized. The utilization timing mechanics are published by the credit bureaus themselves. None of it is hidden behind a paywall or restricted to finance professionals. It is simply not in anyone's financial interest to explain it clearly to the people paying the most for not knowing it. The credit scoring system was designed by lenders to serve lenders. It predicts default risk so that institutions can price loans accordingly. It wasn't designed to help borrowers understand how to optimize their position within it. The information asymmetry between what institutions know about the system and what most consumers know is not an accident. It's a structural feature of an industry that generates revenue from the gap. The strategies in this video do not involve disputing accurate information, exploiting glitches, or misrepresenting financial reality. They involve understanding the rules of an existing system and operating deliberately within them. The same thing every financially sophisticated institution already does. The difference between a 659 and a 771 is not a difference in financial character or responsibility. It's a difference in knowledge. James's 11 weeks cost him nothing but the time it took to understand what he was doing. What it produced was a lower rate, a lower monthly payment, and over $200,000 in interest he will never have to pay. That's the value of knowing what the system actually measures versus trusting what the system wants you to believe. If this changed how you think about credit and the rules underneath it, share it with someone who is paying more than they should because they don't know what James knows now. And if you want to keep going deeper into the financial mechanics that actually determine outcomes, stick around. That's exactly what this channel is here for.